here. I, like a big part of the country, have recently got over the flu, and the residual cough is still lingering a bit, so I'm going to apologize ahead of time if I clear my throat or give a little cough periodically. And having said that, Petersen International Underwriters is delighted to be a partner with the Plus Group. The Plus Group advantage to insurance professionals are that they have solutions for just about everything in the world of disability insurance, and through their different resources can provide solutions to numerous different things. Today's topic is on 5 common disability problems that producers encounter very often, and there are actually solutions to close more sales. And again, through the power of the Plus Group, these solutions are available to you. Let's start with a basic premise here, that most people believe that their personal plan or their business plan, their financial plan, whatever they wish to call it, they've thought long and hard and spent many times, maybe even spent time with insurance professionals perfecting their plan. And they think that this personal plan and this business plan is afloat and working beautifully. The reality, though, is that most plans actually have some serious holes in their coverages. Sometimes they are not even aware of it, and as insurance professionals, we have the opportunity to explore where those holes are, and the good news is we've got some amazing plugs to fill those holes. Now, when we talk about the 5 common disability problems, they fall into, many of these fall into these 5 categories. The first one is not enough coverage. Second one is not any available coverage. The third one is business applications, and we're talking about oftentimes ones beyond the more traditional types of business coverages. And then we have a whole slew of special situations, which we'll touch on in a little bit. And then the last category, which I call the, oh no, what the heck am I going to do for this one category? So let's take a look at these in each of their categories. And the first one we want to touch on is the not enough coverage. And in the world of not enough coverage, we have a premise here that once a person secures either group or individual disability coverage, depending upon their income level, there may be times that they need more than what the traditional markets can offer them. This we call excess coverage, or there is a need for excess personal coverage. So the question first, to set the record straight, is there really a need for excess disability insurance? A couple of surveys that I'd like to share with you to, again, kind of set the stage here, is that U.S. News and World Report magazine did a survey of their readership. Most magazines do this. They do it for the purpose of looking at the demographics of who reads their magazine, so then they can go to their advertisers and says, here's the average makeup of the readership of our magazine. And what they found was, regardless of a person's income, the average person, the reader of the magazine, dedicated about 40% of their income to the mortgage of their house. Now, if you notice, I said 40%. I didn't say a dollar amount. And if you think about it, a person who makes, let's say, $100,000 a year of income, they own their own house, it's going to be a certain size house. A person who makes $1 million a year of income probably has a bigger house, more likely. So the percentage stays the same, but the dollar amounts increase dramatically. Now, that U.S. News and World Report also found that an additional 35% was needed for those living expenses, such as the bills and food and basically the overhead just to live. Now, if that wasn't enough, the U.S. Bureau of Labor Statistics did a sampling of over 73 million people in the United States. And although this was done for completely different reasons than U.S. News and World Report, what they found was, on an average, 35% of a person's income was dedicated to the mortgage of the house, regardless of income level. So even though that number is a little bit smaller, the same illustration applies. 35%, it was not a dollar amount, it's a percentage of a person's income dedicated just to the mortgage of their house. Now they went on and found that approximately 40% more income was needed to pay for the bills and the income or bills, overhead, food, whatnot. Bottom line is this: right around 2/3 of a person's income is needed just to live. That's to survive, not to thrive. Now, 2/3 is not just a made-up number. If we look to our other industry experts, such as group disability carriers, what do group disability benefits typically cover? 2/3 of a person's income. It wasn't an accident that they came up with that number. If you look to our educational programs within the insurance industry, such as the RHU or the DIA or the LUTC program at the American College, they all conclusively say about the same thing. Right around 2/3 of a person's income is needed just to live. So the argument is that the person's comfort level, proper protection is about 65% of their income, regardless of income level. Now, here's what oftentimes happens in the traditional insurance markets. As a person's income goes up, the percentage that they are provided goes down. If we look at group disability insurance as an example, oftentimes they'll say, we cover 2/3 of your income up to $10,000 a month of income, or $15,000. Even personal disability insurance does the same thing. Personal disability insurance through the traditional markets does a fantastic job for the vast majority of people out there. But as this chart shows, as a person's income goes up, that percentage drops down. If you look at a person who makes an income of about $500,000 a year, they are looking at about 40% of their income being covered by that one source. The point is, 2/3 is what they need. So excess disability insurance comes in and layers on top of either the individual disability or group disability or both to bring a person up to the appropriate amount of coverage, which is that need line there. And the smaller the incomes, the less need there is, but there's still room in there for needing excess coverage. Higher the income, the more excess coverage is necessary. Let's put this into illustration format so it makes more sense. Looking at a personal disability plan, here's our classic physician, and this particular physician's income is $600,000 a year. Now that's not an unusually high number for a physician, but it's obviously not a low number either. It's a number that is out there and is quite frequently obtainable in the physician market. If you break that $600,000 a year of income down, that translates to $50,000 a month is their income. And if you apply that 2/3 rule, or 65%, what they need is $32,500 a month. Well, oftentimes they can't get that either on the individual or the group side. So again, that excess coverage comes in and layers on top of whatever that base plan is to bring them up to $32,500 a month. So the next time you're looking at your client and you are requesting a proposal from the Plus Group and you say, I need to see the maximum I can get, that maximum might come in two forms. It's going to come from two different companies. It's going to come with a base program, and then it's going to come with an excess plan to give you that maximum. Excess disability plans are written on an individual basis. They're written on a multi-life basis, in which case you can start getting discounts for these individuals, and also as a GSI group program as well. Classic example would be your top executives of a large company, and those top executives may all have large incomes, in which case their group and their individual coverages might, again, not be providing them that adequate amount of coverage. Then the group GSI plan, excess plan, can layer on top of that to give them that additional benefit as well. Continuing on with our not enough coverage, we also want to not forget the business disability markets sometimes have a need for more coverage. Let's take a quick look at business overhead expense. Now, business overhead expense, if you think about it, this is how it works. A self-employed person has one income and two budgets. They have a personal budget, which is what the personal disability insurance is designed to cover. And then they have this business budget. Now, the business budget is what the business overhead expense is designed to cover. So in our example here, we have an attorney who has a small, medium-sized law firm. And they have figured out that their monthly overhead expense to run that operation is $50,000 a month. Now, $50,000 a month is not an unusually high number for a law firm. By the time you add up rent, insurance, the utilities, staff overhead, you're there. It adds up very quickly. And here's where that excess comes into. Within the traditional disability markets, oftentimes the issue limits are $30,000 a month. That leaves a gap of $20,000 a month in overhead expenses should this person become disabled. Excess coverage comes in and layers on top of that to give them the $50,000 a month that they truly need. Now, the importance and value of business overhead expense, business owners actually already see and understand. In the world of property and casualty insurance, we have a program called business interruption coverage. Business interruption coverage says that should you not be able to open your door Monday morning because of a fire, theft, or vandalism, we're going to pay your overhead expenses. What if the reason you can't open your door Monday morning is because you, the owner, cannot open your own door Monday morning because you became disabled over the weekend? This is a classic example of where people will insure their things first and foremost before they insure the one thing that makes all else possible, their ability to work and earn an income. Let's take a quick look at a buy-sell situation. Businesses need to address four key elements within any form of the assets, four key situations. They need to address what's going to happen if this company ever has a voluntary withdrawal, a dissolution, a death, or a disablement between the partners. Now, I don't think anyone would disagree as to the need for this type of a planning. And designing a buy-sell is actually very, very simple. Step one is to agree to the terms. What's going to happen and when? And step two is to plan for the funding. Now, no one says insurance has to fund anything in a buy-sell, but insurance is definitely a good use of money in many situations, such as in the death, you could use life insurance. Now, one of the things that can come out of life insurance, if it's a cash value type of life insurance, is it could be creating cash values within it, which could help fund withdrawal and dissolution, and that's great. Couple of unique things here. Withdrawal and dissolution, you have some degree of control. In other words, you can pick when this event is going to happen. You could say, April 1st, we're closing our doors forever. You know what, we're running out of money, and I think starting June 1st, that's going to be the end of this operation. Pick and choose, and that's great. You have the ability to control that. A death or a disability has no control. Whatever you need to do has to be pre-planned. If you're a CPA firm, you cannot put out a bulletin to all your employees and say, attention employees, there will be no deaths or disability occurring before April 15th. We're just too busy, we have too much going on here, and we do not have time for you to die or become disabled. It doesn't work that way. When these events happen, they're instant and you have to deal with them. Now, disability, unlike death, presents a much more difficult problem because you see the disabled owner is actually dead from a productivity standpoint, but it's illegal to bury them. You cannot get rid of them. And a disabled owner they have a changed voice. They are now in survival mode. They are no longer interested in building the company. What they need and what they need to have is full salary, full benefits, split of the profits. And when do they need this? They need it right now. And what are they giving back to the company? Absolutely nothing. And until this company can get rid of that person, this is a very, very bad situation for that company. The wonderful thing about a buy-sell is it forces the disabled owner to sell and the non-disabled owners to buy at a pre-agreed upon price or formula. Hooray! It's a built-in market already in place. And that's a wonderful thing. Now, key person disabilities. Key persons are found in, I contend you will find a key person in every business. Sometimes you have to look a little harder and it may not be real obvious, but every business has a key person. Let me use a classic situation that would make sense. Paramount Pictures decides to make another Terminator movie, and this time they say it's got to be Arnold, because Arnold is the proverbial Terminator. So Paramount Pictures says, Arnold, we're going to give you $1 million just for signing your name, and we have about 4 months of pre-production work ahead of us, and that's going to cost us another $2 million. So 3 months from now, 4 months from now, we need you on the set ready to go. Wonderful. What if between now and then Arnold rolls one of his Humvees and breaks his neck? He's not going to make it to the film. No Arnold, no movie. Now, Paramount is stuck, and they've spent $3 million. Arnold's already received $1 million just for having signed his name. So what are they prepared to do? A key person life policy and a key person disability policy will fund benefits back to Paramount to make them financially whole again. And then they can make some choices as to whether they're going to scrub the movie and do another project or try to reconfigure the movie somehow. Now that's kind of an obvious high-end type of example. The story I'd like to share with you is a number of years ago, and this was going back about 20-some years ago, there was a company in Santa Monica, California that was involved with laser optics. Now lasers were brand new at that time, and this particular company was a multi-million-dollar revenue company. And one day they realized that there was this technician who had one job, cleaning and adjusting the lenses and the mirrors of these lasers. And if that technician disappeared on them, they were dead. They were completely dead in the water. They also looked about as to what would happen if that technician disappeared, how easily would it be to replace them. And again, lasers were brand new at this point in time. And what they found at that time is there was only one other person in the entire United States who could do what that person did, and that person worked at MIT. What do you think the chances of them getting that person away from MIT was? Yep, you're right, probably 0. So here you have a technician, not an executive, not a manager, not an owner of the company, but a technician who is a key person, critical element to the success of that company. I put to you, ladies and gentlemen, every business has a key person. Sometimes you just have to look for them. Now, where this comes in from the excess disability, where the not enough coverage is, all of these programs, personal disability, buy-sell, business overhead expense, and key person, they exist in the traditional markets, but oftentimes they are limited to a certain benefit amount. Buy-sells, for example, typically have a maximum benefit of about $2 million, maybe $3 million in some case. Do you know any companies worth more than $3 million? Of course, we're surrounded by dozens and dozens of companies worth well more than $3 million. So an excess buy-sell could come in to layer on top of that base coverage to give them the appropriate amount that they need. Let's take a look now at the not any available coverage situation. And first, it involves occupational issues. If you thumb through the occupational guide of most companies, you are going to see no, 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 no in a lot of places. That no means that they're not available they don't have any benefits available for that particular occupation. There's not a day that doesn't go by that we don't get a call from somebody that says, I have a client who is a, and you fill in the blank. And it could range from an entertainer, a pilot, an athlete, a musician. Well, you say, well, come on, Tom, those are all high-end, super cases. Yep. How about martial art instructors? Anybody Everybody out there you probably drove by several martial art dojos in your area. Those instructors have a very difficult time finding disability insurance, especially if any of them compete too. You have artists, commercial divers, venture capitalists, jockeys, horse trainers, and tuna boat captains. And people kind of chuckle when they see tuna boat captains. What do they need disability insurance for? You know, I've seen the deadliest catch. Do you realize that tuna boat captains, on an average, make over $250,000 a year of income? And you say, for driving a boat? No. Tuna boat captains have to find tuna. Time is money to Starkist. Tuna boat captains have to know where the tuna is, not just drive the boat. So it's an expertise that has developed over those years. And we casually glance over these occupations and say, oftentimes, these are uninsurable. The answer is no, they're not. There is insurance marketplaces for these people. Other things that fall into the not any available coverage are avocational issues. So we come along and we find this wonderful textbook case. Here's a business executive, 40 years of age, great income, and they don't have any disability insurance in force. Yoo-hoo, this is going to be a great slam dunk sale here. And they say, oh yes, and by the way, I race cars every weekend throughout the year. Well, these weekend warriors, these semi-professionals or even professionals, whether they're race car drivers or scuba diving instructors on just for fun or search and rescue, they too can still obtain disability insurance. Sometimes companies might say we're going to exclude while they're racing and driving, and other times the companies may say, no, we don't want anything to do with that person because of that avocation. Well, there are markets that can cover them just while racing or practicing, and there are markets that can cover them to include while racing and practicing. And again, the strength of the Plus Group is that the resources are there for you to make those sales regardless of these common problems that we run into. Continuing along with the not any available coverage is older ages. Isn't it interesting that so many companies believe that at age 65, you're done. That's it. You're retiring at that point. Personal disability coverages for most companies typically end at age 65 or 67, and they might continue on for year to year or maybe 2 years beyond that. And buy-sells, more times than not, completely end at 65. In fact, sometimes in the buy-sell world, starting at age 60, the benefit amount of the buy-sell for that person starts decreasing over time to where at age 65 it zeroes out. And why is this? Because they all believe that at age 65 the person retires. Well, we all know people way past age 65 that continue to work. Those of you who know my father, Harold Petersen, he's 84 years of age, comes into the office every day. He loves this business and is still just as strong at it as he was 20 years ago. So, you know, what are these people to do? They still have a need for disability insurance and the buy-sell to continue on and the key person policies and all these other coverages that have traditionally they've had. They can still continue on even in those older ages. Let's take a look at some business applications that are slightly different from the traditional markets. And the first one is the loss of future earnings. Loss of future earnings? I thought disability insurance is based upon income. Well, generally it is, but it doesn't have to be. Let's take a look at Sam here. Now, Sam is a college senior. So what kind of income do you think Sam makes right now? Yeah, probably zero. He's a student. Okay, you might say minus $40,000 and counting because of his tuition, and that may be right. But nonetheless, Sam's income is currently zero. But Sam here has a very unique talent. He can throw a 100-mile-an-hour fastball and hit a dime. So being in his senior year, he has a lot of player agents from different professional baseball teams wanting him to sign and turn professional. And the second Sam signs, what's his income going to become? You're right, millions. Millions if he's that good and that fast at it. Well, Sam says, you know, I want to finish my senior year, so I've got a couple more months of school ahead of me, and then I'll turn professional. Well, that's great. But what if between now and then the car crash occurs, the falling down the stairs accidentally happens, something happens to destroy his pitching ability, and now Sam has a 10-mile-an-hour fastball. What's his income potential in the major leagues? Zero. He's back to being a student. So a disability policy is available that can fulfill a loss of future earnings based upon this type of situation. Other business applications beyond the traditional include bank loans. Now, right now I'm not talking about home loans, mortgage disability plans. I'm talking about business bank loans. When a business takes out a bank loan, many banks today are saying not only do you need life insurance, but you also need disability insurance. And people are very quick to say, oh, I'll just assign you my personal disability benefits. What? What are you doing that for? Your personal disability benefits were for your personal budget. So bank loan indemnification disability plans are designed to be basically decreasing disability benefits that typically most business loans are a maximum of 10 years in duration. Some of them are 5 years and some even shorter than that. So the disability plan just has to dovetail with what is happening with that particular bank loan. And in the event that a person becomes disabled, let's say on year 5, a bank loan indemnification plan will fund to the bank the balance of the loan that's due. And so then that makes the bank security that they required up ahead of time, and the individual is able to continue on with their business as planned. Severance agreements. This is kind of a timely topic and has been for the last couple of years. I'm sure every one of us knows somebody who's been outsized, right-sized, downsized, early retirement, forced retirement, golden parachute, whatever you wish to call it, but they have basically been receiving a severance package to leave the company. I even have a personal friend who fell into this same trap where she was kind of excited initially. She said, this company was very good to me. They offered me a full year of salary as severance, and here's the kicker, full benefits. Woo-hoo! Full benefits. Well, when someone says that, you want to look closely because you say, are you talking about including the group disability insurance? Oh, yes, of course, that's part of the benefit packages. Ah, here's our problem. Group disability insurance has a clause in it that says you must be actively at work. And the second you take one step out of the company, guess what? You are no longer actively at work. So they do not have the group disability insurance. But who promised it to them? The employer. So here is a liability risk that's just waiting to happen as a ticking time bomb. And I guarantee you that if the severed employee suffers a disability, there will be a discussion between two people, and they will both have JD after their name. Severance agreement disability plans do exist where they basically mirror the benefits that the person had from their group disability plans, provides them the coverage for usually 1 to 2 years at a time, with the idea that within that year the person has found a new job and hopefully is on the new benefit structures with that particular company. But what it is designed to do is mitigate the liability of the employer. Let's take a look at some special situations which do pop up periodically. Pension completions. This is especially timely because, again, because of our economy, people pay attention to what their savings accounts have been doing, what their 401k is doing or not doing. You understand that in the world of group disability insurance, group does not count as income money that you've been putting into the pension plans. That money is separate and not even acknowledged. So if you say that, well, the group disability gives me sufficient personal coverage, that's great. but it's doing nothing for the amount of money that you're putting away into your pension plan. A pension completion disability plan is designed to provide the funds that in the event that you become disabled, there's basically two structures that are out there. One is the benefit is funded as if it's the complete 401k or pension plan, but it is held in trust until you turn 65, just like the regular pension plan would do as well. The other strategy that's out there is that a lump sum benefit is paid at the time that a disability occurs. Typically there's an elimination period of 1 year or 2 years. But this lump sum is then handed to you, and you now have a choice to make. Yes, it is your retirement that you're holding in the palm of your hand, but you may need that money, that extra money, at that point in time. But if you don't, you can then control what you're going to do with that money and either put it into a savings, into some sort of trust or whatever to carry on. The point of all this is that when you're looking and talking to your clients, you want to make sure you acknowledge all their income sources, including the income that's going to these pension plans as well, and that those are adequately protected. And then our last category that we run into, there is really almost unlimited, but these kind of fall into the, oh no, what the heck am I going to do for this one? And these include things such as short-term needs. Person approaches you and says, I need 3 months of disability insurance because I'm working on this special project. I'm working on a contract for just the next 90 days. Is that possible? Well, the answer is yes, it is. There are programs out there that are available for that. Or multinational situations. You have two parties that are trying to do a business deal together. They might need a buy-sell agreement, but it happens to be one of the partners is located in Japan and the other partner is here in the United States and a third partner in the UK. It gets quite complicated for many companies, but there are programs available for multinational situations. High net worth and high unearned income individuals. Sometimes we look at people with a high net worth or a high unearned income and we just automatically assume, oh, there's nothing for you because you could sit home and be getting paid just as much as if you're up and about. Well, that's not always true. Many times the unearned income person still has to be on site. Property is a good example. Your property doesn't just provide payments from renters without someone talking to them, without someone managing them, without someone occasionally stopping in on them. So oftentimes unearned income is not necessarily generated if you are completely out of the picture. But again, case by case, each one of these are situations, but there are markets for all of these. Business overhead expense we talked a little bit about, but sometimes there's some special situations that that you run into. A physicians group with 8 physicians. Many times companies who do write business overhead expense will say, no, we're not going to do that because they have so many people doing the same practice that if one person becomes disabled, the 7 other physicians can pick up the load. Have you ever talked to somebody in those situations and say, do you think you can do more work than what you're doing now? They usually say, I'm up to my eyeballs in work. I can't do anymore. So the theory is interesting. The reality is it's not true. They have a need for business overhead expense, even if there are many partners in the same occupation within the same company. And these two, there are markets for these. Buy-sell issues that occur. 2 partners, one is 60 and the other is 25. Ooh. Some companies that write disability buy-sells will pass on that because they look at such a large age differential that they're positive that 60-year-old is looking for a way to check out. They're ready to retire, and they're planning to use this program for funding that. Well, as we pointed out earlier, that's not correct. That's not true. The these older age people will continue to work. And just because they have a young partner doesn't mean they're planning to bail. So again, there are markets that can come out there. So if you encounter one company that says no, keep talking to the Plus Group, because they've got other resources that can fill in these gaps. And key person issues that occur commonly. Some of the companies that do write key person policies, they only have very selective occupations. They only have selective ages, younger ages typically, and oftentimes limit the benefit amount to a certain prefixed maximum. So again, these are all situations that we can work around and work to resolve. So when you're facing a client and they're giving you this description and you're thinking back to what you traditionally do, you shouldn't get frustrated and say, oh my gosh, I can't help you with that. Because the real answer is you probably do have solutions for it. You just need to have the resources to get those products for you. And again, that is one of the major strengths of the Plus Group partners around the country. They can provide all those different resources for you. So here it is, ladies and gentlemen, the financial bottom line with what we've just been discussing today. Statistically, 65% at the minimum is required just to survive. That's industry numbers, that's non-industry numbers. That is proven time and time again that about 2/3 of a person's income is needed just to live. Second point is that businesses can very easily fail without the individual at the helm, or without enough cash to keep the business moving properly. Even if that individual might be able to come back, it still needs funding to continue on with what it has to do. The other thing, too, is from a sales standpoint, something I want to share with you, is that I think the industry has done a disservice for a number of years in some of its training, because they say, it's classic LUTC, say, look the person in the eye and say, what would you do if you couldn't work for the next 6 months or next year? What would you do without your income? Well, the real answer is, I don't care. What do I mean by that? A person who's sick or hurt severely enough is mentally not in the mode of caring. When you get the common cold, are you sitting there thinking to yourself, oh, I'm going to get up and do the bills? No, you're sitting there with a head under the pillow and you're in agony because your sinus is hurt and the aspirin hasn't kicked in and you have a fever. Now that's the common cold. Think of what happens if it's a broken neck. Think of what happens if it's the heart attack. You could care less about what's happening in the rest of the world. What you should be doing is looking that person in the eye and say, what's your family's plan to do should you not be providing the income to keep the family operation going? Suddenly it's a different picture. Suddenly it's a different discussion, because it's the family that gets impacted more than the disabled person. And that's the reality there. Ladies and gentlemen, there are serious holes in most business and financial plans. The cool thing is that we all have the ability to look for them, talk about them with our clients, and when we identify them, either we've identified them or they've approached us for them, there are solutions for them. And again, it goes back to the strength and the power and the resources and the tools available through the Plus Group. And with that, ladies and gentlemen, I thank you for your time today. I applaud you for being involved in this wonderful industry. It is fantastic and amazing, and thank you again. And I will give this back to Tracy.
Again, if you'd like to ask a question, please go to the question pane on your control panel and type it in. I do see one question here, Tom, from John Bowman. His question is, what about restricted stock agreements?
I'm sorry, say again, restricted
what about restricted stock agreements?
Restricted stack agreements?
Restricted stock, S-T-O-C-K, agreements.
Restricted stock agreements. I'm not sure I've got an answer for that one, because I'm not sure in which context we're asking about it.
Also, he says stock options.
as far as being able to insure them I guess is the question. That may be a question offline because
okay.
I think I
Mr.
need
Bowman,
more information.
we can get back to you on
yeah,
that.
I'm sorry about that.
Vesting, if you're not working, you're not vesting. Tom, he said helpful indeed. Okay, well, we'll figure it out. We can get back to John on that. And yeah, other than that, looks like we're good. Tom, thank you so much for your time today. We appreciate it. Plus Group thanks you. And again, if anyone has any additional questions, feel free to contact me, Tracy O'Malley, or your local Plus Group office, or Tom directly, and we'll get back to you. And we appreciate everyone joining us. Please check our website, www.plusgroupus.com. for future webinars. And again, we thank everybody for coming today. Thank you, everyone. Have a wonderful day. Bye-bye.